Welcome to Her Wealth Journey. Did you know that the average American pays nearly $10,000 in interest on a personal loan they could have gotten at half the rate just by knowing where to look and what to ask? That number should bother you, because it's not about being bad with money. It's about being kept in the dark about a system that is designed to confuse you. Personal loans are everywhere right now. Banks, credit unions, apps on your phone, pop-up ads promising fast cash. And here's the thing. Personal loan debt in America just crossed the $1.3 trillion mark. People are borrowing more than ever, but most of them have no idea they're overpaying by hundreds, sometimes thousands of dollars a year. So today, we're breaking it all down. How to actually find the lowest personal loan rates, how to compare them the right way, and how to walk away saving real money, not just feeling like you did. Let's get into it. Here's the problem most people run into. You need money. Maybe it's an unexpected medical bill. Maybe you're consolidating credit card debt that's charging you 22% interest. Maybe you want to finally fix the bathroom that's been a disaster for 2 years. Whatever it is, you need a loan and you need it soon. So you Google it. You click the first ad, you fill out an application, and within minutes, someone's offering you a loan at 19% APR. You think, okay, that sounds reasonable, and you say yes. And that's exactly what they're counting on. Because you didn't know that someone with your exact credit score, in your exact situation, could have gotten that same loan at 11 or 12%, maybe even lower. That difference doesn't sound huge until you do the math. On a $15,000 loan over 5 years, that gap costs you over $3,000 extra. $3,000 gone for nothing. The urgency is real. Interest rates have been volatile. Lenders know when people are desperate. And the lending industry profits enormously from borrowers who don't comparison shop. So the solution is simple in theory, but most people skip the steps that actually matter. Let's fix that right now. Point 1. Understand what actually determines your rate. Your interest rate is not random. It is calculated based on a few key factors. Your credit score is the biggest one. A score above 700 generally unlocks the best rates. Below 650 and you're in a different tier entirely, sometimes paying double. But here's what most people don't know. Your debt-to-income ratio matters just as much to some lenders. That's how much you owe versus how much you earn. Even with a great credit score, if 40% of your income already goes to debt payments, lenders see you as risky. Clean up that ratio before you apply if you can. Loan term also affects your rate. Shorter loans often have lower interest rates. A 3-year loan may cost less in total interest than a 5-year loan, even if the monthly payment feels higher. Point 2. Pull your credit report before you apply. This is non-negotiable. Go to annualcreditreport.com. That's the only federally authorized free site. And pull your reports from all 3 bureaus: Equifax, Experian, TransUnion. Look for errors. 1 in 5 Americans has an error on their credit report. Even something small, like an account that was paid off but still shows a balance, can be dragging your score down. Disputing and correcting an error can raise your score by 20, 30, even 50 points in some cases. That bump could move you into a better rate tier and save you thousands. Point 3. Use pre-qualification, not applications. This is a huge mistake people make. They apply to 5 different lenders hoping to find the best rate. Each application triggers a hard inquiry on their credit. Multiple hard inquiries in a short period can drop your score by 5 to 10 points each time, which then hurts the rate you qualify for. It's a trap. Instead, look for lenders that offer pre-qualification with a soft credit check. Most major online lenders like SoFi, Lightstream, Marcus by Goldman Sachs allow this. You enter basic information, they show you your likely rate, and your credit score is not affected. You can pre-qualify with 6 or 7 lenders in one afternoon without any damage to your credit. This one step alone can save you hundreds of dollars by helping you find the lowest rate without the penalty of applying everywhere. Point 4. Credit unions are seriously underrated. Most people go straight to big banks or online lenders, but credit unions consistently offer lower personal loan rates than traditional banks, sometimes 3 to 5 percentage points lower. That is not a small difference. Credit unions are nonprofit. They return profit to members in the form of lower rates and fewer fees. The National Credit Union Administration shows that the average personal loan rate at a credit union is around 9 to 10%, compared to over 11% at banks. But here's what most people don't know. You don't have to be born into a credit union. Many have open membership based on where you live, where you work, or even which associations you belong to. Search credit unions near me, or check the NCUA website. You might qualify for several without even knowing it. Point 5. Compare APR, not just the interest rate. Lenders are sneaky with this. They advertise a beautiful low interest rate in big, bold letters. Then, buried in the details is an origination fee of 1 to 8% of the loan amount. That fee gets added to what you owe or taken out of what you receive. The number you need to compare is the APR, the annual percentage rate. That includes the interest rate and the fees. It's the true cost of borrowing. Always ask for the APR. Always compare APRs across lenders. A loan with a 9% interest rate but a 5% origination fee might actually cost you more than a 10.5% APR loan with zero fees. Point 6. Timing and negotiation are real tools. Most people don't know you can negotiate a personal loan rate. You can, especially at credit unions and community banks. If you've been a customer for years, if you have direct deposit, if you have a savings account with them, use that. Ask for a loyalty discount. Ask if there's a rate match policy. Also consider timing. If your credit score is currently 640, wait 60 to 90 days, pay down a card or two, and you might jump to 670. That could drop your rate by 1 to 2 full percentage points. Sometimes patience literally pays. Point 7. Watch out for prepayment penalties. Once you have the loan, always read for prepayment penalty clauses. Some lenders charge you a fee for paying off your loan early, which sounds insane, but it's legal and it's common. If you plan to pay extra every month, and you should, you need a lender who allows that without penalty. Finding the lowest personal loan rate isn't luck. It's a process. Check your credit, pre-qualify with multiple lenders, look at credit unions, compare APRs, not just interest rates, negotiate if you can, and time it right when possible. This is how real money stays in your pocket. If this video helped you, subscribe to Her Wealth Journey. New videos drop every week on building real financial confidence. And if you want to go deeper, watch our next video on how to pay off personal loan debt faster using the avalanche versus snowball method. The answer might surprise you.